Hello, dividend growth stock investors. It's Colby the DGI Crab. It's the weekend. It is Sunday, March 30th, and you know what that means. It is time to go over each of the 60 stocks that this channel focuses on and try to figure out where that value lies. The markets continue to be down. And if you haven't watched my video I put out on Friday, giving you a pep talk for why you should be excited about that as a dividend growth stock investor, go check that one out as well. This one, we're going to be looking at the numbers and discussing where the best values are for each individual category, because those 60 stocks are split into 4 separate tiers based on the age of the investor, which I believe age and time horizon is the most important metric that any dividend growth stock investor should take into consideration. So for those of you who are new, I'm going to go over the DGI Crab investing strategy. I will say, though, I'm not a professional financial advisor. You should always do your own due diligence prior to investing your hard-earned money. Now, my strategy, if this is your first time here, and a reminder to those of you who may not be new, what I do each week is I put 50% of my new money into age-appropriate ETFs. So I have automatic diversification in my portfolio no matter what decisions I make with the individual single stocks. And then for the stocks I'm purchasing, I'm looking for the ones that are yielding at least 30% or more above their 4-year average yield. Now, I have my own personal list of top 10 favorite dividend growth stocks. If any of those 10 are yielding 20% or more above the 4-year average, regardless of what tier or age range they're in, I will go ahead and add to those positions, because by the time I'm retired, I definitely want to have strong positions in those 10 companies. Now, I will remain within my own tier unless there is a stock in a different tier yielding 50% or more above the 4-year average yield, because I want to take advantage of that perceived value, get better share price appreciation potentially, and most importantly, get more bang for my buck on the dividend yield. And then finally, if there are no viable stocks within my particular tier, I will not invest less that week. I will just simply do an ETF double down. I'll just put 100% of my new money into the ETFs for that particular week. So as we go into the spreadsheet here where we've got the different tiers, we're going to start with our young investors age 30 or 18 to 30, where we're looking for lower starting yield but very aggressive dividend growth. So you're talking about yield in the mid 1% range, give or take. And we want double digit year over year annualized dividend growth, because that is going to create a crazy amount of passive income increases the longer that you are in the market. Sorted by the valuation tab, where I am comparing the current day yield compared to the 4-year average yield. I update the 4-year average yield every single week, so we've got the most up-to-date numbers on this right down to the basis point. Nike and Nordson are in the green category, meaning they've hit that 30% or more undervalued valuation. Nothing new here. Nike and Nordson have been the two dogs in this category for the last 4 or 5 weeks now, at least. And because they're both 50% or more undervalued, I could make the argument that any age tier could be investing in these, not just the young folks. Nike right now, my gosh, they just continue to fall. I've looked at the Nike financials recently, you guys. Somebody emailed me a week or two ago. They said, DGI Crab, ever since you started the channel last summer, Nike's been your most undervalued stock in the tier 1 category. Are you getting uncomfortable with that? And based on the financials that I'm seeing, the last earnings report that came out was pretty good from what I could tell. Nike certainly seems to have enough free cash flow to comfortably cover that dividend, continue to kick out dividend increases. They increased that dividend by like 8.5% last year. So I'm feeling pretty good about this one in general. You're getting a 2.5% yield on this one when the 4-year average yield, while it has ticked up since last summer, is still just sitting at 1.23%, making it more than 100% off the 4-year average yield. I'm still all over this one, you guys. I add a little bit to my Nike position each and every week, and I have been doing so for quite a while now. Overall, because the share prices continue to plummet, I'm down on the overall value of the position, but I'm not concerned about the overall value of the position. So long as that dividend continues to increase, I'm going to let the dividend reinvestment do its thing, get those raises year over year, And I'm pretty confident that years from now, I'll be looking back at buying Nike for $63 a share. My God. And just be blown away that I was able to load up on this one while it was so cheap. And Nordson, 1.5% or higher starting yield on this one when the 4-year average hasn't quite hit a full 1% just yet. Great value here on Nordson. And then I will point out, you guys, so long as Microsoft, here in bold here, this is one of my top 10 favorite dividend growth stocks. I'm I'm not doing it right now because look, guys, I'm 41 and I've got a fairly healthy Microsoft position as it is. But if I'm in that 30 years of age or younger and I'm building up that portfolio, getting Microsoft with a current day yield above the 4-year average yield just in general, not a bad idea. I think I'd be adding to Microsoft at this point in time if I were you guys and take advantage of the slump. Okay, for tier 2, the age 31 to 41-year-old investors, I'm in this one until November of this year, so I continue to add aggressively to Target, to Hershey, and yes, NextEra Energy still in that buy zone. American States Water was there last week. Their share price ticked up just a little bit, which means at 77.69. I'm going to be a stickler on that. Probably going to wait for American States Water to drop down to about 76 before I add any more to that one, especially when there's 3 better values above it. Target right now yielding well above 4%. I don't know how long it's going to take Target to pull its way out of the slump that it's been going through right now, but it just looks like a can't miss value right now. Even if they stay down here at around $100 to $105 for the rest of the year, that's probably still only going to pull that 4-year average yield up to like maybe 3% by the time the end of the calendar year is over. And then it's still going to be looking pretty good by my estimation. Target's a dividend king. Dividend increases might not be as strong while they're working their way out of this, but I think they'll get back to doing good, solid dividend increases for us in that high single-digit range, at 7 to 9, maybe even 10%. And I'm going to get paid pretty well to wait for it right now with that 4.32% starting yield. Tier 3, 42 to 53-year-old investors, fairly similar to the Tier 2 stuff, but the starting yield's going to be just a little bit higher than Tier 2. Growth rate might be a little bit slower. These are all really steady Eddie companies, a lot of dividend kings in here that have been doing this for decades now. And by doing this, I mean raising those dividends year over year without fail. Archer Daniels Midland yielding comfortably above 4%, still far and away my favorite of this particular category. Watched some coverage on some other channels about the reconstitution of the ETF SCHD, and I've seen that Archer Daniels Midland is now one of the top 10 holdings in that ETF. That is the internet's favorite dividend growth ETF, SCHD. If it's good enough for SCHD's top 10, it is good enough for this crab. I'm happy to continue adding to ADM at this point in time. We've still got good solid value here with Hormel. Hormel's climbed back above $30 a share, so it's not quite as attractive as it was down at like 28, but I'm still pretty happy to add it at this point in time. It's still clearly in that green buy zone. Genuine Parts Company, I think that tariffs could be part of the problem here for Genuine Parts Company, or fear of tariffs and how that might affect the automotive parts industry. Genuine Parts Company, they're a dividend king, you guys. They've got, I don't have it in front of me right now. It's like a 60-plus year streak of increasing those dividends. They've seen tough markets before. I'm not worried about that. I can get a starting yield at right at around 3.5% when the 4-year average is 2.5%. Great value there. T. Rowe Price back to yielding above 5.5%. T. Rowe Price has really had a tough last couple of years. But this is a company that famously doesn't carry debt. I think they could pretty comfortably continue to raise their dividends, even if it's a little bit slower over this next year or two than they typically do. Kind of like Target, I think they'll work their way out of this, but you're going to get a really high starting yield and get paid to wait. And then Pepsi, another one of my top 10 favorite dividend stocks in the buy zone just for standard stocks in my list here. I'm certainly adding to Pepsi. 30% higher yield than average on Pepsi all day long. I hope it stays down here below 150 for a while more. I'd like to keep adding to that Pepsi position, you guys. I hope you're adding to yours too. Let me know if you are down there in the comments. Okay, everybody, the last tier here, tier 4. This is for the 54 and older investors. We're looking for higher starting yield here. especially for those of you that have hit age 54 and you're still building up that portfolio to try to get enough money in dividends to retire comfortably off of. It's going to be harder to add stuff like Nordson down in tier one when your starting yield's just 1.5%. You're probably going to want to look for higher starting yield than that, at least 4%, but hopefully more in that 5 to 6% range. These high yield stocks, these are the stalwarts amongst the high yield stocks. It's a lot tougher to find really high yield stuff with a strong track record of consistent dividend growth. These 10 were the best that I could find. And I'll tell you what, they've performed pretty darn well, if I'm being quite honest with you. People kind of point at Realty Income as one that's been kind of down for a little while, but it's not remarkably undervalued by any stretch of the imagination. I was pretty happy to add some Realty Income to my Roth when the current yield topped 6%. Right now, I'm just going to be sitting back and waiting on all of these. I don't see anything that just jumps out to me as a screaming buy. So that means that we're going to be doing ETF double down for the tier 4 investors. So we'll kind of transition over to that, look at the strategy and how that breaks down. I have this set up in percentages here, so you can think about this as like if you do $100 a week, what percentage of that is going to go into your portfolio. I'm going to start up here with the ETFs, you guys. For the tier 4, since I was just talking about them here, they've got a pretty complex grouping of ETFs that I've kind of assembled for them because for tier 3 and younger, you can focus on dividend growth stocks and ETFs that are loaded up with dividend growth stocks. But once you get up to 54 and older, you really ought to start considering some alternative investments and strategies that are going to generate you some higher yield. So my primary ETF for this group is SPYD. It's nothing exciting. It's just the top highest yielding 80 stocks in the S&P 500. Generally, you're going to have about a quarter of that is going to be real estate stocks, which there's not a ton of real estate exposure in the group of 60 that I've set aside. So I really like SPYD for that. It's not going to blow you away, but you're going to get good solid starting yield in like the 4.5% to 5% range. And it should be just a pretty stable player regardless of what's going on in the markets. And then SPYD is still my favorite high yield bond ETF, very low expense ratio, good high starting yield, pays out monthly. PFFA for preferred shares. This is another high yielding monthly payer that gives you exposure to something besides just standard shares of stocks. MLPX, the ETF for MLPs. This is going to be the only MLP exposure that I personally have in my portfolio. MLPs have a little bit of extra tax complications, but this ETF does not. So this is going to be one that when I get up into my 50s, I'll be excited to start adding to that. And then I've got my 3 favorite covered call ETFs here. Devo, which I think of as almost like the original covered call ETF. I don't know if it's the oldest one that's out there, but really great strategy, good monthly payer. And then JEPQ is going to give me that covered call strategy for the NASDAQ 100, and SPY is going to give me that for the S&P 500. Love all of these options here. A bunch of monthly payers with the exception of SPYD and Devo. And a lot of high starting yield. So instead of doing 15% and 5s down the board here, I'm going to do 30% and 10 because there's not any individual single stocks I'm liking in that tier 4 group. And then for tiers 1, 2, and 3, I break it down like this. S&P 500, small cap, dividend growth, international. VYMI is my exclusive international investment, 5% across the board, regardless of age tier. Tier 2, same 4, just with more emphasis on dividend appreciation versus S&P and small cap. Tier 3, SCHD, VYM, DHS are my favorite higher dividend focused ETFs in this particular category. I think SCHDs perform the best from a dividend perspective of the 3, so I'd probably break it down about like that. You can pick your favorite from that group. And then this is going to be pretty darn similar to last week for the most part, you guys. Your tier 1 group, they really ought to hit Nike and Nordson within their own tier. And I think Microsoft is still a good play at this point in time. And because Pepsi's in my top 10, I'd allocate there, along with Target, Hershey, and ADM as 50% or higher yielding stocks in other tiers. Tier 2 would start in their own tier, Target, Hershey, NextEra. Grab some Pepsi, ADM, Nike, Nordson. And then finally for the tier 3s, Pepsi, ADM, Hormel, GPC, T. Rowe, Target, Hershey, Nike. And then for the tier 4 group, I'm going to just go with T. Rowe Price again for that extra 5% because I don't double down on the international. So I'd throw a little fiver then in there at T. Rowe. Let me know what you guys are buying. I'll talk to you next